Hey everyone, welcome. Today, we're going to dive into a really fascinating and, frankly, kind of weird investment strategy. It's all about finding incredible value in places most people have already given up on.
So let me just ask you something straight up. If you saw a wallet for sale for $60, but you knew for a fact, no tricks, that it had a crisp $100 bill inside, would you buy it? Of course you would. It sounds almost too good to be true, right?
Well, here's the thing. This isn't just some fun thought experiment. This exact logic was one of the secret weapons that a young Warren Buffett used to start building his massive fortune. We're not talking about some complex algorithm or predicting the future. We're talking about figuring out what a company is worth right now, even if it looks like it's on its last legs.
To really wrap your head around this, let's actually forget about the stock market for a minute. Just picture that local shop on the corner. You know the one, with the big going out of business sign in the window. So how would you figure out if buying that failing business is a good deal? It's actually a pretty simple three-step process. First, you sell off everything left on the shelves and get all that cash. Step 2, you take that cash and you pay back everyone the business owes money to, the landlord, the bank, you name it. And finally, the moment of truth, you look at the pile of cash you have left over. If that pile is bigger than what the owner's asking for, well, you've just found yourself a fantastic deal.
Okay, so now that we've got that idea down, let's take our little closing down store analogy and turn it into the actual financial formula that value investors use to hunt for these kinds of deals in the stock market.
It's got a name, Net Current Asset Value, or NCAV for short. The easiest way to think about it is as a company's shutdown value. The formula couldn't be simpler. You take all the company's current assets, which is basically its cash and inventory, and you subtract its total liabilities. And that word total is absolutely crucial because we're assuming the company has to pay back every single person it owes money to, like tomorrow. Let's put some numbers to this to make it super clear. So you've got this company, Company A. It has 50 million yen in current assets. Cash, inventory, stuff it can sell off pretty quickly. Now, it owes a grand total of 30 million yen to its banks, its suppliers, everybody. So you do the math. 50 minus 30 gives you a liquidation value, an NCAV, of 20 million yen. But, and here's the kicker, the stock market is selling the entire company for just 12 million yen.
And that gap, that 8 million yen difference, that's the whole point. That's the magic right there. In theory, you could buy the whole company for 12 million, shut it down, sell off the assets, pay the debts, and walk away with 20 million for an instant 8 million yen profit. I mean, this is literally what investors mean when they talk about finding a dollar bill on the street selling for 60 cents.
Okay, but hold on. This leads to the big question, doesn't it? If the math is so simple and the deal looks so good, there's got to be a catch. Why on earth would the market sell a company for so much less than it's worth in a fire sale?
It's the obvious question. If you can do this simple math and find these opportunities, why aren't all the big hedge funds and Wall Street pros all over this? Well, it's because these companies are usually cheap for a very, very good reason. They are often just plain terrible businesses. And there are two giant flashing red lights you have to watch out for. First, there's the cash burn problem. Think of the company's value as a melting ice cube. It's losing money so fast that by the time you actually get to liquidate it, there might be nothing left. The clock is ticking against you. Then there's the inventory problem. What if the assets on the books aren't actually worth what they say? You know, what if it's a warehouse full of old, outdated cell phones or racks of moldy clothes that nobody is ever going to buy?
And all of this brings us right back to the strategy's nickname. It's called the Cigar-Butt strategy. And yeah, it's a pretty gross image, but it's perfect. You're essentially looking for a cigar that someone has already smoked and tossed on the ground. It looks disgusting, nobody else wants it, but you know there might be one last free puff left in it.
This quote just nails the mindset perfectly. You're not buying in with the hope that the business will have some miracle turnaround and become the next big thing. Nope. You are making a very simple, very pessimistic bet that this company, even if it completely fails, is worth more dead than the market thinks it is right now. So let's put it all together. The Cigar-Butt strategy is about hunting for companies that are trading for less than their liquidation value, their NCAV. You're searching for that discarded cigar that still has one last free puff of value left. But you've got to be so careful about the big risks, the company burning through its cash, or its inventory being worthless junk. It's a deeply conservative, almost pessimistic way to invest.
And that really leaves us with the final big question. In today's market, which is so full of tech companies and intangible assets, does this old school, gritty, asset-based way of thinking still work? How do you spot the difference between a business that's truly worthless and one that's just a discarded cigar butt, waiting for someone to come along and find that one last, very profitable puff?